Fixed income securities are debt instruments that pay fixed interest payments until maturity. Derivatives are financial instruments whose value is derived from the value of other assets. Both are essential for portfolio diversification, risk management, and income generation. The valuation of fixed income securities involves calculating the present value of future cash flows discounted at the required rate of return. The yield to maturity, YTM, is the internal rate of return earned by an investor who buys the bond today and holds it until maturity. The bond pricing formula considers periodic coupon payments and the face value discounted by the YTM. Let's calculate the price of a bond with given coupon payments, face value, and yield to maturity, YTM. We apply the bond pricing formula, which involves discounting the periodic coupon payments and face value by the YTM. This example demonstrates the bond valuation process. Duration measures the sensitivity of a bond's price to changes in interest rates. Modified duration adjusts Macaulay duration to account for the bond's yield to maturity and compounding periods. Convexity measures the curvature of the price-yield relationship of a bond, providing a more accurate estimate of price changes due to interest rate movements. Let's calculate the modified duration and convexity of a bond. First, we determine the Macaulay duration by calculating the weighted average of the present values of cash flows. Then, we adjust it to find the modified duration. Finally, we calculate the bond's convexity using the present values of cash flows. This example demonstrates how to measure a bond's sensitivity to interest rate changes. Analyzing fixed income securities involves evaluating various risks, including credit risk, the risk of issuer default, interest rate risk, the risk of changes in interest rates affecting bond prices, inflation risk, the risk of inflation eroding the purchasing power of bond payments, and reinvestment risk, the risk of cash flows being reinvested at lower rates. To assess the credit risk of a bond issuer, we analyze the issuer's credit rating, review financial statements and key financial ratios, and assess the issuer's industry and economic conditions. This example demonstrates how to fetch financial data and calculate important ratios for evaluating credit risk. Derivatives are financial instruments whose value is derived from underlying assets. Common types of derivatives include options, futures, forwards, and swaps. They are used for various purposes, such as hedging against price fluctuations, speculating on future price movements, and arbitraging price differences. The Black-Scholes model is a widely used model for option pricing. The formula calculates the price of a call option based on the current stock price, strike price, time to maturity, risk-free rate, and the cumulative distribution function of the standard normal distribution. The terms D1 denier and D2 denier are intermediary calculations used in the formula. Let's calculate the price of a call option using the Black-Scholes model. We identify the required inputs, including the stock price, strike price, time to maturity, risk-free rate, and volatility, then apply the Black-Scholes formula. This example demonstrates how to value an option using this widely used model. Fixed income securities involve valuation using present value, duration, and convexity. Bond valuation includes calculating bond prices, duration, and convexity to assess interest rate risk. Evaluating credit risk involves assessing the creditworthiness of bond issuers using financial ratios and market conditions. Derivatives, such as options, futures, forwards, and swaps, are used for hedging, speculation, and arbitrage. Option valuation can be performed using the Black-Scholes model, which values options based on underlying asset parameters.